What's up everyone? It's Guys here, and it's official. You're watching this video right now because you want to make money investing. So today, I want to give you my complete guide on how to invest step by step in 2025. Now, since we're so early into the new year, we should also talk about some of the new changes that have been made throughout the different markets and what that means for you and your portfolio. After all, with interest rates expected to fall in 2025, we could see a whole host of new opportunities that might not be around for much longer. And if you're someone who wants to take full advantage, then you're going to want to listen up. Although before we start, as usual, if you appreciate all the information, it does help out tremendously if you subscribe. It takes you just a split second, and it helps me make more great videos like this one. So thank you guys so much. And now with that said, let's begin. Alright, so first we got to clear up one thing. Investing is not as complicated as most people make it out to seem. In fact, once you get the hang of it, it's actually fairly simple and takes only a few minutes each and every week to maintain. Not to mention, when done correctly, it can provide you with an additional source of income in a tax-advantaged way, while building wealth at the same time. So to explain exactly how this works, here's a simple step-by-step guide to get you started. Step No. 1. Open a new Roth IRA. This allows you to invest and save up to $500 a year, and any profit that you make will be completely tax-free at the age of 59 and a half. Although in the meantime, if you ever need access to that money before then, you can always withdraw your initial contribution penalty-free at any given time. Step No. 2. Open a new investment account. For this, I recommend Vanguard, Charles Schwab, or Fidelity simply because they offer commission-free trades. Then from there, you're going to link your bank account and transfer over the money that you want to invest. From there, you can fund your account and look for a stock that you want to buy. In terms of where to do this, I've used M1 Finance, Webull, and most recently Sophie Invest. They're all commission-free and allow you to build a diversified portfolio relatively easily. Or if you prefer to go the more traditional route, you could certainly use Vanguard, Charles Schwab, or Fidelity. Either way, the choice is yours. But ultimately, it all comes down to personal preference. Step No. 3 is to decide what you want to buy, and this is where most people spend far too much time worrying about the little details when the reality is you really don't have enough information to make a precise prediction either way. So instead, the best course of action is to stick with what you know and buy companies that are priced below their fair value while avoiding anything too small or too risky. In terms of how to determine this, there is no exact science, but typically a good place to start would be to look for companies that have been around for a while, have a proven track record of profitability, and have a history of paying dividends to shareholders. That way you know that you're buying a business that has already stood the test of time, is financially stable, and has a competitive advantage that will continue to grow long into the future. For example, Bank of America currently pays a 3.4% dividend yield and is priced 25% below their 2-year average. Another would be Procter & Gamble, which is currently yielding to 0.7% and is also trading below its 2-year average by about 8%. Or even Home Depot, which is currently yielding 3% and is trading below its 2-year average by 6%. All of these companies have been around for a long time. They have a proven track record of success. They pay dividends. And if you're buying them right now, you're also getting them at a discount. Step No. 4 is to hit buy and sit back. This is where a lot of people make the mistake of trying to time the market, buy low and sell high, when in reality, the best thing that you can do is just buy and hold. Now, obviously, if you feel like a company is significantly overvalued or is likely to file for bankruptcy anytime soon, then it might be worth selling. But besides that, your time horizon should be measured in decades, not in days. For instance, JP Morgan found that the S&P 500 has had an average return of 8% since 1926. Realize that includes dividends, and after adjusting for inflation, the real return is closer to 6%. The point being is that it doesn't matter how much you think you know about the market or how well you think you can predict its movements, your chances of actually being right are very slim. So instead, you're better off just buying and holding long-term, especially since the market historically recovers within 1 year 98% of the time. So that's the overview. Now let us talk about some of the new changes that you should be aware of in 2025. The first is that the SEC has recently approved a spot Bitcoin ETF. Now, if you haven't heard, an ETF is basically like a basket of securities that can contain anything from stocks, bonds, commodities, or even cryptocurrencies, and they can be bought and sold just like a single share of stock. However, instead of owning one asset, you're gaining exposure to a whole group of them. In this case, the new ETF will hold spot Bitcoin, meaning it won't use leverage or derivatives, which makes this one of the purest ways to gain exposure without actually having to buy and store Bitcoin directly. The only downside is that it's not quite available yet, but hopefully sometime soon, and when it is, it will be listed under the ticker symbol. The second change is that the government has imposed restrictions on retirement accounts. If you've ever thought about investing in cryptocurrencies, well, now you can. See, the issue was that the government was concerned about protecting investors in the event that the provider were to go bankrupt. To solve this, they passed the Secure Act, which requires custodians to obtain appropriate insurance, maintain adequate reserves, and establish procedures for quickly liquidating assets. However, as a result of this, many cryptocurrency exchanges have decided to stop offering custodial services, leaving you with only a few options, including self-custody, which could be the target of hackers or exchanges that comply with the new regulations like Coinbase, Gemini, and eToro. Personally, I'd love to hear your thoughts about this down below in the comments section, because I am curious what you think. And finally, third, we got rising interest rates. With inflation beginning to slow down and prices becoming more reasonable, the Federal Reserve is likely going to drop rates back down to stimulate the economy. This is what happened back in 2020, and it's entirely possible that something similar could happen again. In fact, Goldman Sachs believes that the Fed will cut rates twice this year. Barclays thinks 3 times, and a survey of Wall Street banks says an even more aggressive for rate cuts by December. However, it is important to remember that the Fed has stated multiple times that they intend to keep rates higher for longer. So this is something that has to be taken with a grain of salt. On top of that, it's also worth mentioning that not all rate cuts are created equal. Typically, the biggest impact occurs after the initial increase, because as time goes on, businesses tend to adjust and find efficiencies despite the higher costs of borrowing. Now, in terms of what this means for you, the general rule of thumb is that for every 1% decrease in interest rates, you could expect the price of bonds to rise by about 10%, the price of stocks to rise by about 1.5%, and real estate values to rise by about 2%. But of course, everything is interconnected, and by the time all is said and done, the actual outcome could be higher or lower depending on a variety of factors like inflation, the unemployment rate, and consumer spending. Although if history has taught us anything, it's that when interest rates are lower, the market tends to go up. Since 1950, the S&P 500 has seen an average return of 15.3% in the year following a rate cut, with a median return of 13.9%. So that's definitely something to keep on the radar. So overall, when it comes to investing for beginners in 2025, it's pretty simple. Open a Roth IRA, open an investment account, buy and hold high-quality stocks at a reasonable price, and then repeat that process for the next 40 years. Of course, there's a lot more that goes into it, like understanding the difference between active and passive investing, knowing which stocks to pick, how to diversify your portfolio, and what to do in the event of a crash. But if you understand the basic principles, you'll be able to adapt to whatever market conditions come your way. For example, if you're looking for more information, I highly recommend checking out this video up here, where I go through several actionable steps that anyone can take regardless of how much money they have invested or their experience level. So with that said, you guys, thank you so much for watching. Also, make sure to subscribe, hit the like button if you enjoyed the video, and let me know your thoughts down below in the comments section. I post new videos every single week, and until next time, I'll see you guys later.